Now, as we move into 2023, we're continuing that same trajectory of broad-based home price declines, faster in some parts, slower in other parts. But as the Fed continues to tighten monetary policy and restrict the access to credit, and as the labor market continues to weaken, which we're seeing the early signs of, then those home price declines will get magnified and start to intensify. But I want to be super clear that when we look at history, the majority of the home price declines occur after the recession is already over. So considering the fact that we're very likely in the very early stages of this recessionary period, we've seen the very beginnings of the home price decline, but I would very much expect those declines to continue and then get magnified as the recession progresses and then ends. And then we'll likely see the biggest decline.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming Eric Basmajian, who's the founder of EPB Research. So, Eric, thank you so much for joining the podcast today.
Thanks for having me on. I enjoyed a lot of your past interviews. Thanks.
No problem. Thanks so much. I appreciate that. And yeah, I'm really looking forward to our conversation because you've been a proponent, and I think it's been for quite a while that you think, or that you're seeing in the data, that there's going to be a housing crash. So I guess from your perspective, is that still on the cards? Are you still seeing that data, or have things changed?
Sure. So I'll give my overall view on housing, and I'll start with a couple of caveats up front. First is that this is obviously a sensitive issue for a lot of people because everyone is in the market for a house, and I want to make it clear up front that if you are trying to buy a house and it's the right time for you, you're in your family formation years, and this is part of a general lifestyle trajectory and it fits within your budget, I don't want the information that I'm using to dissuade you from making a decision like that. However, I do analyze macroeconomic trends. So for people that are speculating in real estate or derivatives of real estate, which a lot of my clients do and a lot of people that watch these programs do, then small changes in home prices or directional changes in home prices can be very significant. So that's really the audience I'm trying to target. That's mostly the people that follow my research. So that's one caveat. The second caveat is that real estate is obviously quite regional. There are some parts of the country that are experiencing very significant declines in prices, specifically some parts of California. And there's other parts of the country that are holding up reasonably well with prices that are still close to their peak levels, namely some of the hot areas in the Southeast. I, again, make mostly broad, macro, national commentary. So my view on home prices will be an aggregate of what the whole country is seeing. But whenever you talk about real estate, it's different than the stock market, which is usually the same for everybody. The real estate market can be entirely different depending on where you are. So with those two things out of the way, my broad view on the housing market was that first we were going to see a very significant, you can call it a crash, in the volume of housing activity. That certainly has occurred. We've seen volumes of new and existing home sales decline somewhere in the neighborhood of 30 to 40%. And one of the papers that I frequently reference is called Housing is the Business Cycle. The title's a little bit reductionist, but the point still holds, is that housing is very important to the overall economy, but it's not the price of the house that's significant. It's the volume of transactions that's the leading indicator, because that's what feeds through to other industries, the retail sales, the construction, the trucking, the transportation, and things like that. So as monetary policy tightens, first, what you see is a very significant decline in the volume of housing activity. That certainly has happened. And once volume declines, then traditionally you see declines in home prices. The volume of housing activity is akin to economic growth, and home prices are akin to inflation. And we know that inflation is a lagging indicator, so therefore home price inflation will be a lagging indicator. So when we saw the volume of housing activity peak at the end of 2021, beginning of 2022, then we saw what is currently the peak in the housing market occur about 6 to 9 months later in the summer and fall of 2022. Now, as we move into 2023, we're continuing that same trajectory of broad-based home price declines, faster in some parts, slower in other parts. But as the Fed continues to tighten monetary policy and restrict the access to credit, and as the labor market continues to weaken, which we're seeing the early signs of, then those home price declines will get magnified and start to intensify. But I want to be super clear that when we look at history, the majority of the home price declines occur after the recession is already over. So considering the fact that we're very likely in the very early stages of this recessionary period, we've seen the very beginnings of the home price decline, but I would very much expect those declines to continue and then get magnified as the recession progresses and then ends. And then we'll likely see the biggest decline. So that was a long-winded answer, but that's my general context of where we stand in the real estate cycle broadly.
Yeah, no, it's a really interesting way to look at it. So, and I guess if we look maybe internationally, and I'm not sure if you look at those markets, how are you seeing those markets? Because I think the US is quite unique, where majority of, especially at the moment, mortgages are fixed rate, whereas a lot of, Canada, UK, Australia are sort of variable. So, are you seeing similar things there, or will they be more impacted?
Yeah, in truth, I don't study those markets that specifically, so I don't want to give overly specific comments, but you're exactly right that the proportion of adjustable rate mortgages outside of the United States is certainly a lot higher than in the United States. So I think one is conservative to theorize that it would be more difficult for those economies to stomach what's been an unprecedented swing in monetary policy.
Yeah, definitely. So you mentioned there are a few that you're sort of looking at these lagging indicators and I guess these leading indicators. And I listened to a recent interview, I think it was only this week, with On the Margin, which is a great channel and I really
Great show.
enjoy. Yeah, and you were saying sort of that you have these buckets that you analyze data and that you use those buckets specifically to sort of obviously look at different aspects of the economy. So maybe can you explain that process and then how that
Yeah.
affects your hypothesis?
I would love to. Thank you. It's a really important point. So I look and I focus on long-term macroeconomic trends. Some people call it the business cycle. We all, somewhat agree that the economy cycles, and if you ask somebody on the street, they'll agree we go through booms and busts. But then when we're living through it, we don't really track the progression of that cycle very well. It is quite difficult to do in real time, particularly when you're trying to stack your personal anecdotes against what you see in the data, because again, this data is an aggregated representation of the whole economy, maybe not exactly your specific situation. So what I like to do is I like to bucket economic indicators based on how quickly they respond to changes in monetary policy. So things that respond very quickly, you would call typically leading economic indicators. And then after leading economic indicators, it typically impacts what we call the cyclical economy. The cyclical economy is mostly represented by construction and manufacturing. And then once the changes go through the cyclical economy, then you start to see it impact what I would call the broader or total economy. That's when you'll see wages start to come down, employment start to weaken, retail sales start to come down. That's all the broader economy. That's actually what people feel in their day-to-day business. Most people will resonate most with what the broad economy is experiencing. And then we have the lagging economy. The lagging economy would be industries that have super long lag times. You can think about non-residential construction. If you were to build an airport, let's say, that may take you 5 years to build the airport. So if you get the contract in 2022, even if the economy goes through a brutal recession in 23 and 24, you're still going to build and continue the construction on that airport. So we have the leading economy, the cyclical economy, the broad or total economy, and then the lagging economy. The first thing that's really important is that it's critical to contextualize where your business or where your investments or where your thought process falls. If you're focused on the volume of transactions in the real estate market, let's say you're a real estate agent, you're going to be very sensitive to the leading economy because your income will most likely be tethered to the volume of activity in the housing market. That already has gone through a very significant change. If you are perhaps a S&P 500 investor, you're going to be more sensitive to the broader economy, not so much the leading economy, because the S&P 500 is comprised of predominantly service-based companies. And if you're a non-residential construction company that builds hospitals and airports and roads, you're going to be in the lagging economy. So it's really important to sort of know where you sit. I track all four of those categories, and I do that through a basket or a composite approach, which is different than most people, but I think extremely effective. There aren't just one leading indicator. There's a dozen of them, or 24 of them, or 6 of them, however many you feel are reliable, but they impact different industries. And if you aggregate 4 or 5 or 6 reliable indicators into one basket and then track the basket, you can improve the reliability or reduce the false signals in your forecast. So for example, no one indicator has a perfect track record. Everybody's looking for the holy grail, but there's not one indicator that nails every peak and trough with perfect precision. But there are a lot of indicators that are 85% successful or 90% successful. So if you take a group of indicators, and let's say you take 8 indicators that are all 90% successful, and the whole basket is moving in one direction, that's a good indication of where that cycle is heading. Or if you have one indicator that's moving higher and 6 that are moving lower, the basket will be pulled down and you're able to weed out that one signal as more of a false flag than if you were just tracking all of these indicators separately. You don't really know which one to go through. So I aggregate these indicators into baskets that represent the leading economy, the cyclical economy, the total economy, and the lagging economy. And when we do that, what we see now is that the leading economy is deeply recessionary. That is defined mostly by your soft commitments, I would say, your building permits, your new order commitments, things that would represent activity several months in the future. All of those things are clear-cut recessionary because they've contracted from their peak levels and they haven't yet recovered. When we move to the cyclical economy, which is the construction and manufacturing sector, what we see is that that portion of the economy has slowed from what was a tremendous boom at the end of 2021 and beginning of 2022, growing at 9 or 10% growth rates, which is remarkable, to about 0. So the cyclical economy is teetering on the edge of a recession. We see job losses in the manufacturing sector on an on and off basis. So one month we lose jobs, then we gain. They're certainly not hiring. There's not been mass layoffs yet, but the employment market has really softened in those areas. The total economy is in a very similar situation as the cyclical economy in that the growth rate was very high. We've come all the way down to about a 1% growth rate, so very close to recessionary conditions. And because the leading economy hasn't really recovered, there's not a strong prospect for the total economy to have a growth rate that moves from 1 to 2 to 3. It's more likely to continue that progression from 3 to 2 to 1 to 0. And then, of course, the lagging economy is actually still quite strong. That would be your non-residential construction. So that's the broad overview of where all the different economies stand currently. And hopefully any of the listeners can sort of mentally picture where they or their business fits in those 4 categories. And hopefully they're able to see something similar to what the data that I'm presenting shows.
Yeah, I found it a fascinating way to look at it that I hadn't thought of, but it's really intuitive. So you mentioned these buckets, and obviously there's these different indicators in them, and they have a different percentage of predicting certain events. Do you weight them as well, depending on, I guess, the impact they have on the economy, or are they just more sort of evenly weighted? How does that work?
So it depends. Sometimes there will be sometimes there will be a weighting effect to certain categories, but I think what's a little bit of a nuance in what I do is that the aggregation or the construction of these composite indicators is a little bit more involved than just taking a simple arithmetic average of them. So even if the components at the end are weighted equally, they first have to go through a standardization process because, well, let's take the broad economy, for example. If we're looking at the broad economy, we have employment, we have industrial production, and we have retail sales. Let's say those three things go into one bucket. The volatility on a month-to-month basis of retail sales will be much higher than the volatility on a month-to-month basis of employment. So if we can first standardize the volatilities of both indicators, then we can give an equal weight to them in the indicator. But if we give an equal weight to the indicators before the volatility is standardized, then the more volatile component will override and sort of have more than an equal influence on the whole basket. So I think first we have to just kind of standardize everything to make it a similar form. And then we can make the decision to weight a component more heavily than others. And at times it's necessary to do that, particularly because the economy is not a perfectly even basket. And it also depends on what exactly we're trying to tackle here. But I would say that yes, there is a large part of the process that tries to most accurately weight these components because it is a very critical part of the basket approach. There are some indicators, for example, that don't ever contract, not even really in a recession. I'm thinking about some of your super non-cyclical services, like your spending on healthcare and education. Those things don't really change. However, they do make up a large portion of the economy. So when we go through the weighting process, we're keeping all of those things in mind.
Yeah, it makes sense. So if we look at sort of what you've been saying, it sounds like, we either are in a recession or we're very close, and there's not much outlook of that reversing at any time, at least in the next 6 to 12 months.
Yeah.
So
Just one comment
mm,
on that is that I agree with the statement that you just made, and I've been making a similar statement in a lot of my research. But I will say that it's extraordinarily difficult to do this in real time because we're dealing with data that will change. It will be revised and it will look differently than what we're seeing today. And then also, what I have to mention about the recessionary process is that it's really difficult to make a declaration in real time that the economy is in recession today because to some extent it is path dependent. So whether the economy is in a recession in 23 will be determined by what the rest of the year looks like. If the rest of the year is very weak, then based on the data that we have, there's a very significant chance that the recession is backdated to either Q4 of 2022 or Q1 of 2023. However, if the economy does not weaken more from here, then the decline or fractional decline that we've seen in some of the data will look like just a little bit of a blip, and then we'll have continued higher. But we have seen a lot of the key indicators like retail sales, industrial production, and various measures of output and income like gross domestic income. Those have contracted for 2 quarters, call it 6 months, which is a long enough time that raises some flags. If the economy does not experience job losses in the rest of 2023, then the decline that we've seen probably will not be a recession. But if the economy does lose jobs in the rest of 2023, what the NBER will do is they'll look at those indicators and find where they peaked. And a good majority of them have peaked sometime at the end of 24 or end of 2022 or beginning of 23. So you're going out a little bit on a limb by making a call that the economy is in recession now, but it is predicated on the fact that the economy, in my view, is going to weaken more from here, and then the backdating process will take you to 22 or the beginning of 23. So if you go back to 2008, for example, nobody knew the economy was in recession in the beginning of 2008. In fact, Federal Reserve chairmen in their committee meetings were saying retail sales are looking stronger, inflation looks like it's coming back, and we think that we need to raise interest rates. These were conversations that were had in the beginning of 2008. I was actually just reading an article on my computer from the 2008 period talking about how the economy had achieved a soft landing. The worst was behind us. And in truth, at that very moment, the recession was quite mild at that point. And if the economy did not experience what came later in 2008, it's possible that Q1 2008 wouldn't have been a recessionary period. But we ended up having a larger collapse at the end of 2008. And then when they looked backwards, the recession began at the end of 2007. So that's a little bit of context about how these recessions unfold. It's very much a process. It's not an event. And that process is underway. Pinpointing exactly when they're going to nail the start date will be dependent on what comes from the data over the next 6 months, plus what the revisions look like when they're all done.
Yeah, thanks for adding that context, because I think, as you said, a lot of commentators love to add this absolute, like we're definitely in a recession or these things, but it's such a complex thing. Everything's changing, so many moving parts that there's so many things that could change that moving forward, as you said. And the data we get straight away isn't always accurate. I think we've seen some big job numbers get revised.
Yes, just to add one more thing to that point is. On my website, I put some blog posts up, and I put a post up there that was titled "More Evidence the Recession Started," I think it was called. And I went through a methodical process, and the way that I arrived at that title, of course, a little bit of a catchy title, is that the NBER, when they date these recessions, they look at 7 indicators. Everyone thinks they look at GDP and 2/4 of negative GDP. It's actually not what they look at. They don't even look at GDP in isolation. They look at 7 indicators. Those indicators are 2 measures of employment. So the establishment and household survey, which we're all familiar with now. They look at real manufacturing sales, which is very similar to retail sales. Broad aggregate real personal consumption, industrial production, real personal income, so wages. And then the 7th indicator is the average of real GDP and real GDI. They take the 2 of them, which should be statistically the same, and they average them together. So we have 7 indicators to go by. 4 of those 7 indicators have achieved a peak at some point in Q4 or Q1. So because a majority, 4 of the 7 indicators look to have peaked, that's why I'm saying that if the economy continues down from here, when the NBER goes and looks, assuming the data stays the way it is, they'll be able to say a majority of these indicators have had their peak in Q4 of 22 or Q1 of 23. Again, even though those indicators have peaked for now, if they end up rising for the rest of 23, then of course that will be negated. But we can't say that the economy is not in a recession now, because if we do get job losses and the data doesn't change from what we're looking at now, 4 of these 7 critical identifying indicators will likely have had their peak already.
Yeah, it makes sense. And you mentioned their employment. I think that was where my question was going. I feel like the jobs market has been quite resilient, and especially a lot more than most people thought. Even the Fed, they thought we'd probably see more losses at a faster rate, especially with the tightening. So in your opinion, why do you think it has been resilient? And you said it's sort of getting a bit softer. So do you see maybe those leading indicators pushing to the point where it could be getting a bit more? It could be going in a direction where people are going to start losing their jobs.
So when I look at the employment market, I do the same thing as when I look at the leading economy, the cyclical economy. So I'll take a basket of indicators rather than diagnosing the entire labor market off of one monthly NFP number, which is what we tend to do. The number was plus 300,000 this month. Therefore, the labor market is strong. There's actually more that goes into it than just one number. But what I do is I'll look at a basket, again, of 5 or 6 or 7 labor market indicators. I'll look at leading labor market indicators, and I'll look at what we call coincident labor market indicators, which would be your monthly non-farm payrolls numbers. When we look at our leading indicators of employment, those started to contract in Q4 of last year, most likely. So things that would fall into that basket would be your hours worked. An employer will typically reduce your hours before laying off an employee, temporary help services, things like this that are less binding than hiring and firing a full-time employee. So those leading indicators started to contract at the end of last year. Some of them actually started to contract in the summer of last year. So what that tells us is we should be on the lookout for a softening of the labor market. If it comes, it shouldn't be a surprise. And then when we look at our coincident indicators, which really define the labor market, we see that there's been a very significant slowdown in the growth rate. My indicator of the labor market is only growing at a 0.7% rate right now, which is very close to contraction. And the reason that the indicator is being pulled down, despite what looks like strong numbers, is from some of the other components in the basket. For example, even though the economy is adding what seems like hundreds of thousands of jobs per month, the aggregate amount of hours that the entire economy is working is going down. So how is it that we could be adding hundreds of thousands of jobs, but cumulatively working less hours, right? So that component would go into my basket because I believe that that's a strong representation of what's actually going on, but you wouldn't see that if you're only looking at the headline numbers. So there is a lot of softening that's going on underneath the surface when you look at, in my view, a broader and more accurate basket. With that being said, I would have expected at this point that you would have had more significant job losses in the cyclical economy. I don't expect you to have job losses in the services economy until very, very, very late. Your education, your healthcare, those types of things almost never decline in terms of jobs. What we're really looking for is declines in labor that come from residential construction, manufacturing, trucking, temporary help, the parts of the economy that are very cyclical. And when we look at those categories, the ones I just mentioned, they make up about 22 million payrolls. So it's a good chunk of the economy. And those payrolls have been flirting in and out of negative territory every month. Negative 3,000 plus 2,000, negative 4,000 plus 1,000. So on aggregate, there's pretty much we're not adding jobs in those sectors anymore. We're not really losing jobs yet, but it's sort of grinded to a halt. I would have expected them to be falling by now, but we have an unusual phenomenon of labor hoarding that seems to be going on. And that's being captured in the hours worked figure. So what's happening is that employers had a difficult time sourcing these employees over the last couple of years. They don't want to be so quick to let them go because if the economy doesn't go into recession, like we were saying, they're not going to be able to hire them back quick enough to capture that demand or that revenue. So what they're doing is for the most part, all of the cyclical industries have a total hiring freeze. They don't want to hire anybody else. They're not really laying anybody off yet, but they're dramatically cutting the amount of hours. And they're doing that to try and manage their margins, try and reduce some of their expenses without taking the more friction-filled step of actually laying the employees off. So what I do believe is going to happen is that as these employers have sort of bloated their workforce, and we have evidence of that because the productivity numbers have collapsed. That's a concrete evidence that they're overstaffed. but they're almost intentionally being overstaffed because there's a potential for a rebound. Um, that if the demand doesn't come back in the second half of this year, which I don't think it will, then they'll have to right size their workforce quite quickly.
Yeah, it's just I find it fascinating how you connect all these dots and then put it into the analysis. So you mentioned there that you don't think it's going to recover. I guess if we go, we've mentioned the housing market. If we go to other markets, generally, how do we see them react to this data? And then if it were to go the direction that you think it would, how would we normally see the markets react to that?
So I would say again, it depends on what market you're talking about, but we'll sort of rattle through all of the major ones. So again, the S&P 500, which is what most people are referring to when they say the market, is traditionally quite lagging. For a lot of reasons. It has a lot of service-oriented businesses. That portion of the market is usually going to be the last one to break, right? That's focused a lot on, your investment grade, A-rated companies. Those companies will have access to credit up until the very last second, right? But as we go through the market and we sort of, if we say the S&P 500 and the investment grade corporate bond market is at the core, as you move layers and layers to the periphery, the access to credit gets a little bit more touch and go, right? And you're seeing industries that are a little bit more on the periphery having a very significant contraction in the availability of credit. So those markets are seeing stresses. You think parts of commercial real estate, for example. So I would expect very much the markets broadly to react negatively to what I think is a continued contraction in economic conditions, starting with industries that are most on the periphery and then moving towards industries that are closer to the core.
Yeah, makes sense. And are you looking at any other, I guess, macro drivers next 6 to 12 months? Which obviously, I know the economy is a massive thing. We've talked about, I guess, interest rates. Is there anything else that you're currently keeping an eye on?
So there's a couple things, and one of the points I want to make is that again, this is a process, and a lot of this process is already set in stone because once a change in monetary policy, for example, moves through the leading indicators, even if those indicators turn back up, that decline that occurred is still gonna push through the cyclical economy and then the broader economy. So I think a lot of people are seeing this massive decline in leading indicators, but they're not yet seeing the decline in the coincident indicators, and they're saying maybe that decline doesn't filter through. Or conversely, they're saying maybe things are going to pick back up and that decline doesn't actually come through. In my studying of cycles, that's never actually happened before. So what I think is a point of or a piece of the puzzle that people are missing is that even if the Federal Reserve stopped tightening today, and let's say they cut interest rates 100 basis points tomorrow, you still would have the negative effects that have already been built into the leading indicators. Those still would come through the broader economy. Now, maybe the contraction in credit ultimately is not as severe as if they continue to tighten monetary policy, but there's this expectation, I think, that we can avoid a downturn. And based on my process and the indicators that I look at and how they all work in a sequence, that decline is already baked in the cake. It's going to be impossible to avoid it, even if the Fed does reverse course and start easing policy at this point. So I think that's one nuance that people are really missing. The one indicator that I would watch going forward, which at this point of the cycle will probably be our best gauge, is the weekly initial and continued jobless claims. The reason I like those series, specifically for the juncture that we're at right now, is because the BLS, when they report their data, they use survey methods in which they're calling people and asking them questions about their employment. And then they're extrapolating a lot of those survey responses with various models. The birth-death model is the one that people talk about a lot. So after the BLS data gets revised a couple times and we all look at the historical time series, it is quite accurate. But in real time, these model-driven or survey-driven results can be off, specifically during economic inflection points, because those models sort of extrapolate what's already been happening, and they're not great at capturing the pivot points. The second thing that is a little bit difficult with the BLS employment numbers is that they're seasonally adjusted. And these seasonal adjustments have become increasingly difficult in the post-COVID era because, at least in the United States where I am, in 2021, there was a significant outbreak of COVID around the holiday season, Thanksgiving and Christmas. So people didn't go out as much in those December months for holiday shopping as they normally would have. They either did it in January, but then the supply chains were messed up. So some people did their shopping in October. These normal patterns have been slightly deviant from what they are traditionally. Usually they're very consistent. The people that do these numbers, I think, are doing the best they can, and they are trying to give an honest assessment of what happens, but it's incredibly difficult to try and model these seasonal patterns in a world that has had a lot of changes. So when we look at the continuing claims numbers or the initial jobless claims numbers, those are, in my view, more reliable, at least in real time, because they're not based on surveys. They're not calling anybody. They're based on actual filings. Someone actually files for an initial jobless claim, or when money hits their bank account, that's a continued jobless claim. It's more concrete than a survey. And then they also publish the data in a non-seasonally adjusted way. So we can look at the non-seasonally adjusted level of initial or continued jobless claims and compare them against weeks in years prior. And in my view, we can get a more accurate representation of what's going on in the labor market on a more real-time basis. In some of my weekly client updates, I'll put this stuff in there every week and show people how the jobless claim market is moving. But if I had to give people one takeaway or one thing to track, it would be the initial claims numbers. And the reason I'm making it sort of reductionist is because a lot of this stuff is already baked in the cake, right? A lot of this leading indicators are at levels that they're just never at unless the economy is in recession. So that story is pretty much over. The cyclical economy has slowed to virtually recessionary conditions now. It's the broader economy that we're waiting for, and the best real-time signal would be the initial or continued jobless claims. So that's where I'd be focusing on a week-to-week basis.
Yeah, it's great to hear this, and it's just it's something that, as I said before, I haven't really thought about it, but when you hear it, it just makes a lot of sense. So if we mentioned the assets, you said that especially the ones that are sort of on the periphery that are going to struggle for credit in normal markets are really going to be hit by this. Right. We've already seen some catalysts, I guess, in terms of banking crises, and that's obviously there's other factors as well. Do you see any other industries, maybe that aren't generally as cyclical that could be impacted by these
trends? It's always tough to find. We're sort of looking for two things. We're looking for where the credit event is gonna start, and then we're looking for who's holding the bag, right? And sometimes those are two different people. If I was Las Vegas and I was making betting odds, the conservative odds would be that some part of commercial real estate is where the stresses begin. Obviously, office buildings are at the forefront of that. And I think that the banking industry broadly is going through stresses because it's very difficult for them to operate profitably in an environment with such a deeply inverted yield curve. So what's happening is we're seeing empirically in the data and anecdotally that there's a significant contraction in the availability of credit. Every industry is now at risk. And the industries that will probably move to the forefront are the ones that are most reliant on credit. And that tends to be some area of real estate. It's just the nature of that industry. The dollar value of the transactions are so large that there has to be embedded leverage and credit. So whenever there's a contraction in credit, which I think there is now and will continue to be, all industries are at risk and all leverage players are at risk. But if I had to guess, I would stick with commercial real estate, and then there looks to be some anecdotal stresses in auto as well, but auto's not that big compared to real estate. And then if it proliferates further from there, anybody would have just as good of a guess as I do. But I would probably say that. The areas that tend to be the most impacted are the ones that are on the periphery and most reliant on credit as part of the daily operations of that business.
Yeah, it makes sense. So, Eric, thanks so much for your time today. I really appreciate you going through the process and explaining it. So, my last question is, what is one message you'd like people to take away from our conversation?
One thing that I think is really important is you have to look at these cycles as a process, and you have to contextualize where you are in the economy. Are you leading? Are you cyclical? Are you part of the broader services economy? Or are you part of the lagging economy? Or the investments that you're making. I think that I would challenge everybody to try and characterize where they or their investments sit, and that will help give some context about how that asset may perform or the timing of that asset. And then also that this is a recession or a business cycle is a process. It's not an event. Everybody, when they think about recessions, they're thinking about the Lehman crisis, or they're thinking about the bursting of the dot-com bubble. They're thinking about the climactic event that ends up naming that recession, right? And the climax of Lehman Brothers, for example, was part of a process that began in late 2006, early 2007. What I would want the key takeaway to be is to contextualize the different parts of the economy and how they move in a sequence, and then also remembering that we're dealing with a process here, not an event. So don't lose sight of the bigger picture in the wild gyrations of the day-to-day noise.
Yeah, it's a great way to look at it, as I said. So, Eric, thanks again for your time. I really appreciate it. So, we mentioned your research companies are the best place for people can find your work. Is there anywhere else people can find what you do?
I think Twitter is a great place. I'm pretty active on Twitter, and then from there you'll be able to find my website and everything else that I do. So I really appreciate it. This was a lot of fun. Thank you for giving me a chance to rant about some of the views that I have. Hopefully, people found some value in it.
Yeah, no, thank you so much for coming on. I really appreciate it. But thanks again for your time.
All right, anytime.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.